I know what you guys are thinking. Oh my God, another fair value gap video. But I promise this is about to be one of the best videos that you have ever watched on fair value gaps. So give me the next 8 to 10 minutes of your time and I can guarantee that you are going to learn something new. But real quick, as always, if you guys do find value in this video, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. But without further ado, let's hop into the video. All right, so very quickly, I'm sure most of you guys have seen my previous videos on what fair value gaps are. So we're going to look at a bullish example and a bearish example real quick. But essentially what a fair value gap is it's a 3-bar formation. So we're going to have the first candle right here, and excuse my absolute terrible drawing, but we have one candle right there. This is going to be the bullish example, and then a very large aggressive move away from that first candle. And then on this third candle, what we need to make sure is that this wick does not intersect with the top of this first candle right here. So again, we have one smaller candle here. The second candle is a very large aggressive move away from that first candle. And then again, the third candle, the low of that candle does not intersect with the high of that first candle. Now, what this does is this creates an imbalance in the market and an area that price is more than likely going to retrace into before giving a continuation up. So the fair value gap is going to be the distance between the high of that first candle and the low of that third candle. So here's our fair value gap right here. And again, what we're going to look for is price to come down into it, make it support, look for buyers to buy price up, and then push it even higher. So that is a bullish example of a fair value gap. Now for a bearish example of a fair value gap, again, the first candle, it's going to be smaller. Then we're going to have a large bearish move away from that first candle. And then this third candle, the top of it is not going to intersect with the low of this first candle. So here is our low of the first candle. Second candle is a very large aggressive move away from that first candle. And then the third candle's high does not intersect with the low of that candle's low. So the fair value gap is going to be the distance between the first candle's low to the high of that third candle. Now from here, what we're looking for is for price to go up into this fair value gap, make it resistance, look for sellers to enter the market, and then catch the next leg down. So that is what fair value gaps are. Again, this is the bullish example. This is the bearish example. Now let's hop into the charts. I'll show you guys plenty of examples of fair value gaps, and actually one popped up today on NQ. There we go. Okay, so now if we're looking at NQ on the 5-minute time frame, we had price sweep above these highs right here, couldn't hold, and it ended up pushing to the downside. Now looking at this candle right here, it's a smaller first candle, and then we get a very large aggressive sell-off to the downside. Now the top of this third candle does not intersect with the low of this first candle, and as a result, this creates a fair value gap. So what we can do is take this low point of the first candle and draw it to the high of that third candle. Now, as you can see, price came up, rejected it here, and then we dropped all the way down into a new low of day. Over here, we actually have two different fair value gaps. Ideally, I would be looking to use this one right here, but you can see that price came up into it. This was after hours, but up into it, rejected a little bit, and then slowly grind through it. Just remember, this isn't going to work all the time. And then we also had another fair value gap from this candle's low down to this candle's high, and you can see that price rejected it many times before flushing into a new low. Then if we're looking over here, we have a bullish fair value gap right here, very small. Price came into it, bounced out of it slightly. Again, we have a very small bullish one right here that price came into and reacted out of, and I could show you guys many more examples. But when it comes to actually trading using these fair value gaps, you need to understand what is the overall trend. So if the overall trend is up, so very bullish, I don't care about bearish fair value gaps. I only care about bullish fair value gaps. So like right now, right, NQ ended up flushing down into this low. ES actually ended up hitting a demand zone, which is why we've rallied to the upside. So because ES bounced off of a demand zone, I don't care about any bearish fair value gaps right now. We do have one right here, but guess what? Because we bounced off such a strong zone and we got such a strong reaction, I only care about bullish fair value gaps. So I'm going to be watching this one right here. And if price were to come down into this level, make it support, I would look for a long entry. So before you ever enter a fair value gap, what is the overall trend? That's what you need to understand. Do not take any counter trend fair value gaps, because I can tell you one thing, 99% of the time you are going to lose money. Now, the other thing is with fair value gaps, because I do get asked this question all the time, is what time frame do you use? So personally, for me, I really only use fair value gaps on the 5-minute or 2-minute time frame, but you can use them literally on any time frame you want. I know a ton of traders that use them on the 1-hour time frame. I know a ton of traders that use them on the 4-hour, the daily, weekly, whatever it may be. So looking at NQ on the 1-hour time frame, well, there's a 1-hour bearish fair value gap right here. If this is how you like to trade, then that's a level that you would want to be watching. If we go to NQ, I believe it might have been on the weekly a while ago. Yeah, so if we look at NQ on the weekly right here, we have a weekly fair value gap from this candle low to this candle high, projected forward, and guess what? Price went up into it, boom, rejected it, and then we had a nice flush to the downside. If we're looking over here on the weekly time frame, we have a bullish fair value gap right here. So as we see, we had the fair value gap, came right down into it, hit it, and then we rallied into a new high. So again, you can literally use these on any time frame. It just really depends on you. When it comes to the higher time frames, I personally use support resistance, supply and demand, and Fibonacci, and then I'll use the fair value gaps intraday, again 5-minute or 2-minute, to identify an entry point. So feel free to play around with them and see what time frame you like to use the most. Now, the other question that I get asked a lot when it comes to fair value gaps is how do you know like where in the fair value gap to actually look for your entry? Because sometimes these fair value gaps could be relatively large. If we're looking over here, for example, this is a pretty large zone for a fair value gap, right? So if you were looking to enter as soon as price hit the fair value gap at 19,560, your stop loss, I mean, you're talking like, what, 70 points until that stop loss would get hit? That's a very large zone, especially if you're trading NQ. So there's a couple little tricks that I like to use to identify a better entry inside of the fair value gap. So the first way that I like to use is just finding the middle point of that fair value gap. So if you're using TradingView, all you have to do is go to your settings and then check this middle line right here. If you're on other brokers that don't offer that, what you can do is actually take your Fibonacci retracement tool and just measure the low or the high, depending on if you're using a bullish or bearish fair value gap. But you're going to take that first candle, whether it be the high or low, and then you're going to connect it to the third candle, and that's going to give you your halfway point right here. So typically I like to see price go up into the halfway point before seeing some kind of reaction. That way my risk is going to be smaller. Now, not always is it going to get up into the halfway point. It could get a quarter of the way through before reacting to the level. But I like to use this just as like a guide point, as like an ideal entry. So here's a trade that I took in the past using this simple strategy. Looking at the 5-minute time frame on QQQ, we had this pre-market high. Very large aggressive move away once price broke out of that level. We have the first candle high and the third candle low right here. Second candle, large aggressive move away, creating a fair value gap. Well, if we look at where I took that low to that high point, you can see that price came right to the halfway point of that fair value gap and then got a bullish reaction and headed right back into high a day. A little later in the day, came right back down, hit that same exact level, and then we got a continuation even higher. So that's the first way that I'll identify like an ideal level inside of that fair value gap. And again, like if we go to that weekly fair value gap that we talked about, you could have done the same thing because the zone is just so large that you're not going to enter at the very beginning of this weekly fair value gap right here and have a stop loss on the opposite side, because look at how large that zone would have ended up being. If you got short, let's just say 16,026, you're talking like a 200 and what? 200, I'm terrible at math, almost 300 point loss if price were to break above this high. Now in this scenario, no, it didn't hit the halfway point, but once we get that reaction, that's when we can look for the entry. Again, the halfway point is just helping us understand the ideal spot to look to either go long or short. Now, the next way that I like to find my entries using these fair value gaps, and honestly, it's like way better if they both have confluence, but I like to use the 8 EMA. So if we put on the 8 EMA right there, what I like to see is inside of that fair value gap. So actually, let's just use this example right here. But if we were to take a fair value gap from this low to this high right here, I don't know why price won't draw. There we go. Once we ended up getting this fair value gap right here, we can see that the 8 EMA was still inside of that fair value gap. So we could look for price to go into that 8 EMA and end up reacting off of it, because then at that point we'll have confluence of the 8 EMA being inside of the bearish fair value gap. And that just sets up for a higher probability trade. But ideally, my favorite is when this 8 EMA is in confluence with the halfway point plus the fair value gap, because at that point you have 3 different confluences in that specific area, which sets up for a high probability trade. But again, all we need to look for is some kind of reaction. So because this was a bearish fair value gap, we're looking for bearish price action, bearish volume when it gets up into this level. And if we get that, we can take the short position. And if we actually go back to this QQQ example, what do we notice? 8 EMA inside the fair value gap with the halfway point right there. Price reacts off the halfway point, recovers above that 8 EMA with the fair value gap, again, setting up for a high probability trade to the upside. So keep in mind, when I'm trading using these fair value gaps, I'm never entering simply just because there's a fair value gap. I'm always looking for more confluence, because the more confluence we have, the higher the probability of the trade and the higher chance of having a winning position. So if you're struggling using fair value gaps, try incorporating the halfway point inside of the fair value gap, look for a reaction there, but also add that 8 EMA, because once we start to get more confluence inside of that area, it's going to give you a lot more confidence in the position. But that's going to wrap up this video. So as always, if you guys did find value, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. Everybody have an amazing rest of your day, and I'll see you guys in the next video.